Hi guys, welcome back to my channel. Kelvin here. In this video, I want to talk about a very popular CPF strategy called CPF SA Shielding. With this strategy, you'll be able to easily earn an extra few $1,000s worth of interest every year. So that's nice. I will talk about everything you need to know about CPF Shielding. What is it? How to do it? And more importantly, should you or should you not do it? But before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you cute kittens. Alright, let's start right now. Okay, to understand what is CPF Shielding, you need to know what happens at your 55th birthday. Yes, you'll get a birthday cake and a present. But that's not the point. The point is, CPF be like, happy birthday! Here's your CPF retirement account. Then they will take some of your CPF money and throw it inside the retirement account. The money will sit in there forever, gathering 4% interest and thus. And when you turn 65, CPF will finally start paying your money to you. Of course, the total amount that they will take to put inside your RA is the full retirement sum, which this year is at 192k. Okay, here's a quick question. CPF OA or CPF SA? Which account is better for your money? CPF SA writes because it gives a 4% interest, while CPF OA only gives 2.5% interest. But here's the thing, when CPF is transferring money into the retirement account, they will first take everything they can from your CPF SA. Then, if it's still less than the FRS, they will take the remaining amount from your ordinary account. And if it's still not enough, nothing else will happen. So that's good. But what are they taking from CPF SA first? According to CPF, that's because CPF SA is meant for retirement savings, while OA is mainly used for housing and insurance. That's why they are taking from SA first. So introducing CPF SA Shielding. The idea behind this is very simple. I'm super bad at drawing, so I'll just use this fabulous image by Sidley to explain. In scenario 1, you don't use CPF SA Shielding. CPF will take all the money from SA to form the full retirement sum. So you end up with lesser money in CPF SA to earn a 4% interest. In scenario 2, you use CPF SA Shielding. Then, just before you turn 55 years old, you quickly take your CPF SA money and invest it. But just take note, you can't invest everything, yeah? Because CPF only lets you invest anything above 40k. Then on your 55th birthday, CPF first tries to take money from your CPF SA. But they be like, why not enough money one? So they will take the 40k from CPF SA, then take the rest from your CPF OA. Then on the next day, all you need to do is just paper hands, sell your CPF SA investments and transfer it back to your CPF SA, where it will happily earn a 4% risk-free interest. So, as you can see, by using this trick, you'll get to keep more money in CPF SA so that you can earn extra interest. Now, don't underestimate this extra 1.5% interest because of magic of compounding, you will earn a lot more money over the years. Check this out. Let's say both CPF OA and SA have 100k at the start. After just 20 years, CPF SA ends up with an extra 55k compared to OA. And that's just from 100k, yeah. The full retirement sum increases every year. So by the time you reach 55 years old, FRS will definitely be a lot more higher than just 192k. So 1.5% interest is actually quite a lot. Now, I have to admit, when I first heard of this strategy, I have a few questions in mind. First, why not just transfer from OA to SA after 55 years old to earn additional interest? You can't. CPF only lets you transfer from OA to SA before 55. After 55, CPF be like, no, we don't do that here. Second, why not just transfer from OA to SA before 55? Then just let CPF take the full retirement sum. Again, CPF is very clever because they also talk about this beforehand. You can only transfer up to the full retirement sum. So CPF will still end up taking everything from CPF SA. Then the final question is, this trick feels illegal leh. Will CPF call police catch me? Don't worry about that because this trick is very well known. Even CPF says that they know some people are using it and will be monitoring the trend closely. So you don't have to worry for now. Quick pause. Here's a quick message from today's sponsor, Webull. If you trade options frequently, you'll be glad to know that Webull has added stop order and stop limit order so that you can protect your downside while trading options. Also, they have just upgraded their sign-up rewards even more. This time, it's $130 worth of free Tesla shares and a free Grab voucher worth $10. All you need to do is deposit at least 2,000 SGD into Webull, make one buy trade on an US stock or ETF, make another buy trade on one US option while maintaining 2,000 SGD net account value for that 30 days, and you will receive all your free rewards. So if you are interested, you can sign up with my link down below. With that being said, let's get back to the video. Is there any downside to doing this trick? Actually, there is one downside. That's because to do this trick, you need to invest your CPF SA money into something. If you invest in the wrong thing and the market suddenly crashes, you will lose your money. So that's the risk of doing this. Okay, let's take a look at what you can actually invest your CPF SA in. It can be used to invest in ILP, unit trust, Singapore government bonds, annuities, treasury bill, and endowment policies. Now, because your CPF money is meant for retirement, you should only go for short-term investments. That means ILP, annuities, and endowment policies are out. Singapore government bonds are super stable, but they have a very long maturity date of at least 2 years. And it's very hard to sell it on the open market as the liquidity is low. So Singapore government bonds is out too. That leaves us with unit trust and treasury bills. Treasury bills is not bad as there's no risk and the maturity can be as low as 6 months. But historically, the yield has been quite low, though it has been climbing up to 3% recently. However, over the long term, I expect the yield to go back down when the market recovers. So if you invest in treasury bills, you will end up earning a lower interest for 6 months. On top of that, you will need to submit an application in person at the main branch of the bank. So that's super troublesome. If you don't want to do that, your only choice is to invest in unit trust. For this, let's go to FSN1 Fund Selector to find out what funds we can invest in. For payment method, I will set it to CPF IS SA, SGD currency, and for asset class, choose money market and short duration bond. That's because these asset classes have very low risk and very low volatility. There are 3 results here, but the winner will have to be Nico M Shandon Short-Term Bond SGD. That's because it has the lowest risk rating and the lowest expense ratio. Coincidentally, the fund calls itself a parking facility fund for CPF and SRS investment. If you look at the chart, most of the time it's actually quite stable. But the biggest drawdown is during the end of March 2020, where the fund had a 1% drop. So if you are super unlucky that you encounter this drop exactly when you are doing CPF SA shielding, you will need to keep the money in CPF SA for about 1 year to recover the loss. Then as for which broker you can use, there are quite a few brokers to choose from. But I would recommend using Poem's Cash Plus account, as the fee is the lowest at 0.08%, while all the rest charges around $20. Sign up link down below if you are interested, yeah? So that's how to do CPF SA shielding. As to whether you should do it or not, it really depends on yourself. Do you want the additional 50k interest? Some people be like, meh, I got $1.6 million in CPF. I don't need that additional interest. I don't know about you, but additional interest is always good, yeah? That's because once you meet the full retirement sum, anything above that can be withdrawn and used anytime. So if you think about it, after 55 years old, your CPF SA becomes a super high 4% interest savings account. And if you only withdraw 4% or less from SA every year, you will technically have infinite money. So that's nice. Anyway, that's all for this video. But are you planning to use CPF SA shielding or not? Do comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.